Thank you, everyone, for joining this afternoon. My name's Art Criden with In Touch Financial Group, and I work on the life insurance side. And today's topic, we're going to talk about life insurance as a college funding strategy. If any of you were joining us last week, we talked about client conversations and how to, different things we can talk about clients or to clients. And one of them was always the opportunity to talk to clients about education. So we figured we'd go a little bit further on the education side and see how we use life insurance as a way as an option. I don't want to say it's not the only way, obviously, but it's a option that we can have for college education to offer our clients. So we'll get into a lot of different options. We'll talk about two in particular, 529s and life insurance. We'll do a lot of compare and contrast, see what the differences are, and we'll also try to work with. I didn't put it on the presentation, but I do have some examples of what we can. What some illustrations are and how much it contributes to an individual by if we put in a certain amount of money each month, for example. So we'll talk a little about that, and we'll wrap it up with some ideas. So to get started, let me advance the slide here. To get started, this was a fun presentation to put together. One is because it's very relevant for me. My son just graduated high school and will be entering college in August. So a lot of this stuff is really very up to date because it's sort of like living through it. And this was my year, and a lot of your clients, or maybe you personally, will be going through the college selection process and visiting colleges. And to tell you, it was fun last year and earlier this year when we started it, but now with the COVID-19 issues, it's a little nerve-wracking on what the college experience is going to look like starting in August. But a lot of that is to be determined. But today we'll talk about the cost and funding it. In-state tuition for public schools, 63% in a 12-year period, more than private schools. Public schools are going up. Tax issues are always a big question. Private schools have a lot of foundation money, so they sometimes keep their tuitions in line or not as great. But public schools, we're seeing really a big increase in tuition. This was, I found alarming that more students are selecting their school based on price, and 40% of families turn down their first choice based on financial concerns. And I've heard that even from some of my son's friends who, their child wanted to go to one school, but they couldn't afford it, and they selected another school, even though that may have had a better program or something else. But they just could not afford to send their college to their son or daughter's first choice. Average cost of tuition for private schools about $41,000, public schools $11,000 to $27,000. I'll tell you, on the research I did, I think that's probably about right in the schools that we were looking at. A lot of the public schools for in-state tuition were fairly reasonable, and the out-of-state was in that $30,000 range, and private schools were in that probably more in maybe the $45,000 to $50,000 range, some even more. So it is quite expensive, and it does vary quite a bit by school. So it's hard to say exactly what. Let me go back. It's hard to say exactly what the tuitions are. But it does vary greatly by school, but they are expensive. Don't forget about room and board, and this was pretty consistent in my experience. We always figured it was $15,000. Some places were a little bit less. Some places were a little bit more. But that $15,000 for room and board was probably fairly accurate, although a lot of schools now, I know in this coming year, they're going to end probably around Thanksgiving. So they're not going to have that December time period, and they're giving a little bit of a refund, maybe 10% or so. They're cutting the cost by a little bit because a lot of the schools are going to shut down around Thanksgiving time, so they don't have to go and come back. And they are giving some forgiveness on the room and board charge. Average student debt for a college graduate is $37,000. I hear horror stories of kids going through, law school or med school or, postgraduate school, and they're racking up, $100,000 in debt. And that's got to be paid back. When they graduate and they start paying it back, that takes years and years. And that really is a financial burden to either the family or the student. So anything we can do to lighten that student debt load is really going to be a benefit for our child. Okay. Two real, to talk about it, instead of just talking about in the higher 20,000 foot level, I figured I'd go get it down to reality. And what does the actual cost be? Oops, excuse me. The actual cost of the coverage of sending our child to school, and this was interesting that it was $12,000 in tuition for the University of Georgia for just in-state tuition, and I thought that was pretty reasonable. But the idea was that's the in-state tuition. That's for just sending your child, into your home state. Now, if you did out-of-state tuition, man, look how that bumps it up to $31,000. And I found this really cool website called tuitioncompare.com, and it takes the actual cost of the tuition for this year, and it uses some really good estimates on what the tuition will be over the next 3 years. So it gives you a 4-year cost, and for University of Georgia in-state tuition, $49,000 or close to $50,000 for 4 years is probably not too bad. Look at the out-of-state. The out-of-state, for that same example, bumps it up to $127,000. And then if you put in the room and board, it also gives you room and board totals. And I just did 4 years of without any increases, so it's probably be a little bit higher. So it's about $14,000. You can see that's pretty close to that 15. And if you took that out 4 years, it'd be about $57,000 for room and board. So what's your total come to? For 4 years, University of Georgia in-state, a little over $100,000, $106,000. Out of state, about $185,000. So then I also said, well, I was curious what a private school would be. So I just picked Duke in North Carolina, and their tuition is $60,000, and their 4-year estimate is $249,000. So $250,000 just in tuition. And their room and board was a little more on the expensive side at $17,500. So their 4-year total was $319,000. And that's before, I know a lot of the private schools give aid and scholarships, but if you excluded all that, you'd be looking at over $300,000, and that's a considerable sum of money. That's a lot of borrowing, hopefully on scholarships, things like that. But it's if you have to pay that out of pocket, that's a considerable amount of money. Okay, so I just wanted to show you here on some examples of what the true cost is, and these are updated through the 2021 school year, so you can see what it is. So let's go. So what are the challenges of facing the college education? It's really some choices that we or our clients have to make. We have to save for college. We're always saving for retirement. We always have to save for the unexpected. And these are choices we have to make every single day. And, we really can't exclude one. It's great to save for retirement, but how do we, what happens when our child's ready for college? We don't want to take our retirement money to pay for their college, because it's not fair for ourselves, when we're ready to retire. And then also savings for those unexpected expenses. A medical bill comes in, or some extra large expense that we need to do that comes up, that we need to have some money. There's a saying, you should have like 6 months worth of cash, just for, you never know what happens. You lost a job loss or some unexpected medical expense. So we should have some extra savings. laying around just in case. So we have all these choices, but is there an alternative? And what I was looking at here is, if you had a death benefit, a living benefit, and we can build some cash value, that really solves a lot of these options that we need to have. And that really can all be put into a life insurance policy. And that's really the advantage we have in talking to our clients about alternatives. And we'll go into a little more detail on all this, but we want to build that cash. We want to build cash value. Having a living benefit is great. And if there's a death, we want to make sure there's money for the family. Okay. So what are our options to finance college education? One is you can have a savings account. And savings accounts are great. They're the most flexible thing you can have. You're not going to earn a lot of interest these days. If you get 1% on a money market account, you're probably doing really well, maybe 1.25%. You could have a 529 plan. That is the most common. As a matter of fact, 3 in 10 households have a 529 plan now. So that's there's a lot of advantages to that. Life insurance, we'll talk about life insurance, especially about the flexibility of life insurance and how that really can help and mimic some of the 529 benefits in a life insurance plan. And we'll talk a lot about that. And then student loans, there's federal and private student loans that you can take advantage of. Again, we talked about leaving ourselves or our students with these debts that we have to pay back after graduation, and that's really burdensome. Scholarships, well, they're great. I know here in Georgia we have the Hope Scholarship, the Zell scholarships that really can offset a lot of that in-state tuition for our state schools, but they're not guaranteed. And who knows what they're going to be in 10 years, 15 years from now. We don't know how much they're going to cover. They used to cover, I believe it was books and fees and everything. And now they've even cut back because the amount of money that they can contribute has gone down. So the amount of money that's even the state scholarship programs is going down. You can also look for private scholarships. There's plenty of them out there. And there's just infinite options out there, but not everyone qualifies. So scholarships, while they're great, they're not guaranteed. And then work study, sometimes this is a nominal amount, but it gives an opportunity for our child to go into college and maybe work and go to school at the same time. And what they're working offsets some of their tuition costs. So that's always an advantageous type program. May not contribute a whole lot, but every little bit helps. Okay. So with that, to talk about the 529 plan in particular, the account grows tax deferred. So money we're putting in to our 529 plan is not being taxed. I call this the education. It's like an education 401k plan. So you're putting money in, it's growing, and then when you're ready for your college, you start taking it out. Your withdrawals are tax-free if they're used for college expenses, and they just changed the law. It was this year or last year. You can even use it now for private schools before college. So withdrawals are tax-free if they're used for college or just general education expenses. Purchased directly, the fees can be fairly low. If you work with an advisor, the fees can get up there to cover the advisor's costs and things of that sort. So if you purchase directly through your state or through a brokerage house, it's a good program. Fees are low. If you work through an advisor, you're going to pay a little bit more on the fee side. Some states offer a tax deduction. Here in Georgia, we get I think it's up to $4,000 you can deduct from your taxes if you put in up to $4,000. So you get a little bit of a tax break. There's no federal tax break. It's just a state tax break. And every state is different. So, just defer to your own state on the tax deductibility. You can select how the money is invested. I like this option because you can go aggressive, you can go conservative, you can go mutual funds, you can go money market. A lot of them have it where they change the investment with your age. As the age of the child gets older, it becomes more conservative. As they're younger, it's more aggressive. I think that's a great idea. So it's not a one-size-fits-all type of investment. It counts as some of the downside. It counts as an asset in your financial aid calculations. When you do, every parent is required to do a FAFSA form online, and you got to put in all your assets. I recently did this, and it's a mess, but it's you got to list all your assets, and you got to list them. And if you have a 529, you have to put in the 529 into your FAFSA, so it does count against into your financial aid calculations. Principal can be at risk with market volatility. There is a chance if the market if you have your money invested in the market, maybe aggressively, and the market goes down, yeah, you could put your principal at risk. Hopefully, over a long term, that won't be the case, but it does tie into market volatility. And it's less flexible. It has to be used for education. You can't use this for some other purpose. If you do take the money out for non-education expenses, the penalties are up to 10%, plus maybe some tax issues. So there's a lot to consider when you're investing in a 529. A lot of good, but there are some downside. Any questions on 529 plans? Okay. Okay. So now we'll talk about life insurance. As you can guess from the title of our presentation, to talk about the life insurance options. The permanent life insurance offers a death benefit. So if your client, the primary wage earner, dies, it really gives that benefit for your client, the surviving spouse or the children, to finish off their goal of funding for college. So this is one of the primary benefits of a life insurance policy over a 529. If there's a death and you just had the 529, there's nothing in the 529 that can continue that contribution. Whereas in a life insurance policy, the death benefit is going to be a great benefit for that family. So they're going to get this lump sum of money, and they can use that, put that money away for education expense. Like a 529, the cash value accumulates tax deferred. You have to keep the policy in force so you avoid any tax consequences. But you have to. But it's a great way to accumulate the money, not pay taxes on it, and then just take that policy loan when you're ready for college. Biggest thing, flexibility. There's no use on the restrictions. So with a permanent life insurance policy, if your child decides not to go to college, with the 529 plan, there's a couple options, but mainly for your child, you wouldn't have the option to use that money for another purpose, and if you did, you would incur taxes and a penalty. With life insurance, you can use it for anything you like. So if your child decides not to go to college, maybe he or she wants to open a business. That'd be a great way to start funding for a business for your child. Or whatever else the child wants to do. If they want to travel or whatever the case may be, there's no restrictions on the use. Protection for market volatility. For example, we'll talk about this next, is the IUL, the Indexed Universal Life product, or even variable life products. There's some market volatility. The IUL, you get the upside without the downside. That makes it great. But if you want to have a little bit more volatility, maybe a variable policy will help you. It's a great way for you to grow the policy with the market over a long period of time, and that's going to offset a lot of the cost that tuition and room and board, and as those fees increase over the years, at least you get the opportunity to grow your money, maybe at the same rate, maybe more, hopefully not less, but maybe more. Living benefits, a lot of the permanent policies have living benefits. If there's an illness, critical injury, terminal illness, it's a great way to get money out of the policy without dying. And again, it's a way to keep funding for the life insurance policy, or excuse me, funding for the education costs through the life insurance policy. And then maybe one of the better hidden benefits of life insurance and college funding is the cash value is not included in your financial aid calculation as an asset. So here's where you're really taking advantage on the 529. If you're building up a nice 529 balance by the time your child or son or daughter is going to 17, 18, you have a nice 529 plan. That's going to go into financial aid calculations, and that could impact how much money you would get on financial aid. With life insurance, the cash value is not included as an asset, and it does not impact the financial aid that your child will get, like the 529. So the big thing here about life insurance is you need to buy it early for funding for the education. It does take a little while for the cash value to build up, but once that cash value builds up over time, it really is advantageous. Okay. Any questions on the life insurance? Okay. All right, now we'll go to we'll talk about the IUL in particular. The advantages of an IUL, it's tax efficient accumulation. So again, like we talked about on the life insurance, permanent life insurance, it's you're accumulating this tax free. It goes back to what I consider like your college 401k. The money is accumulating. You're not paying taxes on it. Take advantage of the market upside with IULs. You get all the upside. For example, if the S&P 500 index is increasing, your money's going to increase along with it up to a cap. So you're not going to maybe get the full impact of it, but you're going to get the increase on the market upside without the market downside. And that's one of the advantages of the IUL. It protects against your downside risk and gives you the some upside as the market over a long period of time, as the market is gaining, hopefully for all of us, you're going to participate in some of that without the downside if it goes down considerably like it did earlier this year. You can access the money for any need at any age. So again, it's not like a 529, which is just for education. Here, your IUL can be used for any purpose. Again, if the child doesn't go to college, you can use money for that. You withdraw, there's no penalty. And unlike your 529 and 401k, where you would incur a penalty, the money you're taking out, there's no penalties. Guarantee of the death benefit ensures your goal completion. So if there is a death, the primary wage earner dies on a 529, for example, there's no way to continue that funding. With life insurance policy, you can continue to put money away for savings. You have that lump sum, and you can really use a lot of that or any portion of that for education expenses. Access your cash through the policy loans. It's not taxable, but you got to keep in mind that the policy must be enforced. You can't let the policy lapse, or you could have some tax consequences. So you have to keep the policy in force to avoid any tax consequences. Again, living benefits can replace income if there's a critical illness or critical injury, terminal illness, things of that sort. So you take advantage of the living benefits. And then lastly, fees can be lower. A lot of the advisor sold 529s have considerable fees. And so the fees on IULs can be considerably lower than the advisor sold 529s. It could be, but on the other side, it could be a little bit higher on the direct purchase 529s. So you have to watch the fees, but advisor sold 529s can be fairly hefty. So lastly, what do we choose? What are our options? What do we do? Consider all your options for your clients. Discuss them all. You can go back to the other slide where we talked about savings accounts and scholarships, and there's a variety of options. But I think where we talk about life insurance is the flexibility. Is we can do a lot of the things that a 529 can do, but we have the flexibility of how we want to do it, how the money comes out. If the child doesn't go to college, there's no downside. So there's a lot of flexibility with life insurance. So it's really a good option for your clients. You can select more than one. There's no law that says you can't do both. Maybe the best plan is having a 529 and a life insurance policy where you're going to do both. It's up to your client. There's no absolute right choice. There's nothing that says if you do this, this, and this, you have to have that. Each option has ups, downs. There's advantages and disadvantages of all plans. So it's not like you know, this is the best for this client, this is the best for that client. Everything has a positive and negative. So I would say, my opinion is always start now. And when is now? Now is now. Because if my child is 15, you know, maybe I waited too long, but hey, I got 2 or 3 years to accumulate something. If my child is 1 or 2, that's the perfect time. It's never too late to start that program for saving for your child. And whether it's the 529, a life insurance, it's a savings account, no matter what it is, we want to talk to our child, or we want to talk to our clients about their options. But the worst choice is doing nothing. And that's really a good way to approach it with your client. Is we have to do something, because most of us want our child to have a good education, good school, what programs they like, what they want to do in life, and maybe college is the way to go for them. But you know, when they're 1 or 2, you're not going to know. So hopefully that's what we want to do. We want to have that money available. The life insurance option is great because it has the flexibility if they want to do something different. So we want to take a look at all our options, but the worst choice is doing absolutely nothing. And we want to consider everything for our clients. Okay. So with today, we talked about colleges on the last couple sessions that we had over the last few weeks. We talked about the benefits of life insurance. We did a needs analysis. We went in deep on living benefits. We had last week, we talked about different client conversations that we have with clients. And so we've had really good feedback from all our previous sessions. So if there's any feedback that you have on the college funding, using life insurance for college funding, certainly let me know. I'll be more than happy to go into more detail with you. But it's really an interesting way to help our family, help our children. So in the future, we're going to look to selling into the senior market, maybe even talk about how COVID is impacting life insurance, some different marketing concepts like this, where we're talking about life insurance and how we can help our agents, help our clients with different ideas on ways we can help them with life insurance. So if you're looking for an appointment with In Touch Financial Group, and if you're not appointed already, please give me a call. Be more than happy to send you the information, walk you through the process, and partner with our companies, for example, National Life Group. We'll post a recording on our